Auditing the Expenditure Cycle. We will examine audit procedures associated with the expenditure cycle. So, how do we audit expenditure cycle? Let us first begin with expenditure cycle activities and technologies. We have two technologies needed to be evaluated. First, purchases and cash disbursement procedures using batch processing technology, while the second is the modern payroll system that uses real-time processing and database technology. Let us first begin with purchases and cash disbursement procedures using batch processing technology. Where do we start? The purchasing process begins in the data processing purchase department when inventories are reduced by sales to customer or usage in production. The system determines if the affected items in the inventory subsidiary file have fallen to the reorder points. If so, a record is created in an open purchase requisition file. The record contains the inventory item number, a description of the item, quantity to be ordered, the standard unit price, and the vendor number of the primary supplier. The information needed to create the requisition record is selected from the inventory subsidiary record. Then, the inventory subsidiary record is then flagged on order. Remember, it is noted on order to prevent the item from being ordered again until our inventory order arrives. How do the computer system comes into the picture? Our computer system sorts the open requisition file by each vendor number and consolidates it into a single requisition. Next, the vendor mailing information is retrieved from our valid vendor file to produce purchase requisition documents. Copies of purchase requisition go to manual procedures in the purchasing and accounts payable departments. Let's now move to purchasing department. Upon receipt of the purchase requisition, the purchasing department prepares a 5-part purchase order. Copies go to the vendors, accounts payable, receiving, data processing, and purchasing department's own file. Next, we need to discuss alternative approaches for authorizing and ordering inventories. Figure 10.2 illustrates 3 different methods. In alternative 1, this system prepares the purchase order documents and sends them to the purchasing department for review and signing. The purchasing agent then mails the approved purchase order to the vendors and distributes copies to the internal users. Next, the system shown in alternative 2 expedites the ordering process by distributing the purchase order directly to the vendors and internal users, thus bypassing the purchase department completely. Next, alternative 3 represents a re-engineering system that uses EDI or electronic data interchange. This method produces no physical documents like purchase order or sales order. Instead, the computer systems of both the buying and the selling companies are connected via special telecommunications link. So, what are the similarities between the 3 alternatives? In each 3 alternatives, the authorization and the ordering steps in the process are consolidated and performed by the computer system. Purchase requisition document serves no purpose in such system and are not produced. However, requisition records may still exist on magnetic disk or tape to provide an audit trail.
Going back to figure 10.1, let us continue with the step 2 on the data processing department. The purchase order is used to create an open purchase order record and to transfer the corresponding records in the open purchase requisition file to the closed purchase requisition file. In the receiving department, when the goods arrive from the vendors, the receiving clerk prepares the receiving report, and then the copies goes to the purchasing, accounts payable, and the data processing departments. After the data processing department receives the receiving report, it runs a batch job that updates the inventory subsidiary file and removes the on-order flag from the inventory records. The system calculates the batch totals of inventory receipts for the general ledger update procedure and then closes the records for the open purchase order file to the closed purchase order file. When the accounts payable clerk receives the supplier's invoice, he or she reconciles it with the supporting documents that was previously placed in the accounts payable pending file. The clerk will prepare the voucher, file it in the open voucher file, and sends a copy of the voucher to the data processing. Step 4. A batch program validates the voucher records against the valid vendor file, adds them to the voucher register, and prepares a batch totals for the posting to the accounts payable control account in the general ledger. Now, let's take a look at the data processing cash disbursement system column in the flowchart. Each day, the system scans the due date field of the voucher register for the items due, writes checks, and records it in the check register. The check number is recorded in the voucher register to close the voucher and transfer the items to the closed accounts payable file. The checks and the transaction listings are sent to the cash disbursement department. And finally, batch totals of the closed accounts payable and the cash disbursements are prepared for the general ledger update procedure. At the end of the day, batch totals of the open or unpaid accounts payable and the closed or paid accounts payable, inventory, and cash disbursements are posted in the general ledger. The totals of the closed accounts payable and cash disbursements should balance. Then, in the cash disbursement department, the cash disbursement clerk reconciles the checks with the transaction listings and submits the negotiable portion of the check to the management for signing. Then, the checks are mailed to the suppliers. One copy of each check goes to the accounts payable and the other copy is filed in the cash disbursements along with the transaction listings. Upon receipt of the check, the accounts payable clerk matches it with the open voucher and transfers these closed items to the closed voucher file. And this concludes the expenditure cycle process.
Expenditure cycle audit objectives, controls, and test of controls. So, let's recap the concept of audit objectives derived from general management assertions about financial statement presentations. Say it with me. Existence or occurrence, completeness, accuracy, rights and obligations, valuation or allocation, and presentation and disclosure. But let us recall how these translate to specific expenditure cycle audit objectives, shall we? So, here are the relationships between management assertions and expenditure cycle audit objectives. Existence or occurrence. 1. Verify that the accounts payable balance represents amounts actually owed by the organization at the balance sheet date. 2. Establish that purchases transactions represents goods and services actually received during the period covered by the financial statements. And 3. Determine that payroll transactions represent wages for services actually performed during the period covered by the financial statements. Completeness. Determine that accounts payable represents all amounts owed by the organizations for the purchases of goods and services as of the balance sheet date. 2. Ensure that the financial statements reflects all goods and services received by the organization, less returns for the period covered. 3. Verify that the financial statements reflect all wages for services performed during the period covered. Accuracy. Establish that purchases transactions are accurately computed and based on correct prices and correct quantities. 2. Ensure that the accounts payable subsidiary ledger is mathematically correct and agrees with the general ledger accounts. 3. Verify that payroll amounts are based on correct pay rates and hours worked and are accurately computed. Rights and obligations. Establish that the accounts payable and accrued payroll recorded at the balance sheet date are legal obligations of the organization. Valuation or allocation. Verifies that the accounts payable are stated and at correct amounts owed. Presentation and disclosure. Ensures that the accounts payable, accrued payroll, and expenses reported for the period are properly described and classified in the financial statements. Achieving these audit objectives requires designing audit procedures to gather evidence that either corroborates or refutes management assertions. This often involves a combination of tests of controls and substantive tests of details. As for input controls are designed to ensure that the transactions are valid, accurate, and complete. Control techniques vary considerably between batch and real-time systems. The following input controls relate to expenditure cycle operations. Data validation controls. Input validation controls are intended to detect transcription errors in transaction data before they are processed. Since errors detected early are less likely to infiltrate the accounting records, validation procedures are most effective when they are performed as close to the source of the transaction as possible. In the batch purchase system, validation of purchase orders occurs only after they have been sent to the vendor. Because of the inevitable transcription errors that occur in preparation of source documents, such as systems as characterized by the need for extensive error correction and transaction resubmission procedures, on the other hand, the real-time input of time card data can identify and resolve most errors as they occur. This approach also minimizes human data entry and thus reduces the risk of data entry errors. For example, when the clerk enters the employee number, the system automatically retrieves his or her name, mailing address, pay rate, and other relevant data from the employee file. So, here are the terms related in relation to this type of control. Missing data checks are used to examine the contents of a field for the presence of blank spaces. For example, an employee number missing from an attendance record, the quantity received value missing from a receiving report, or an incomplete mailing address in a purchase order record will cause the transaction to be rejected. When the validation program detects a blank where it expects to see a data value, this situation will be interpreted as an error. Numeric alphabetic data checks determines whether the correct form of data is in a field. For example, the quantity field in a purchase order should not contain alphabetic data. As with blanks, alphabetic data in a numeric field may cause serious processing errors. Limit checks determine if the value in the field exceeds an authorized limit. For example, if the firm has a policy that no employee works more than 44 hours per week, the payroll system validation program can interrogate the hours worked field in the weekly payroll records for values greater than 44. Range checks assign upper and lower limits to acceptable data values. This technique can be used to control orders placed with vendors. For example, a range of 500 to 1,000 units can be set as the normal order quantity for a particular class of product. A range check is also useful for controlling payroll transactions. Validity checks compare actual values in a field against known acceptable values. This control is used to verify such things as state abbreviations or employee job skill codes. If the value in the field does not match one of the acceptable values, the record is determined to be an error. And lastly, check digit controls identify keystroke errors in key fields by testing their internal validity. A check digit could be used to verify a vendor number on a purchase order record.
Errors here, errors there, errors everywhere. Data entry errors can slip through edit programs undetected, can cause recorded accounts payable and expense amounts to be materially misstated. The audit procedures that I will be discussing can provide evidence about the accuracy assertion. The central audit issue is whether the validation programs in the data editing system are functioning correctly and have functioned as intended throughout the period. The auditor may decide to rely on the quality of other controls to provide the assurance needed to reduce substantive testing. For example, after reviewing systems development and maintenance control, the auditor may determine that control over original program design and testing and subsequent changes to program are effective. This evidence permits the auditor to assess the risk of material program errors at a low level and thus reduce the substantive tests related to the audit objective of accuracy. If controls over system development and maintenance are weak, the auditor may decide that testing data editing controls will be more efficient than performing extensive substantive tests of details. In this case, ITF or the test data approach can enable the auditor to perform explicit tests of the validation logic. This testing would require the auditor to gain a familiarity with all the validation procedures in place. The auditor would need to create a comprehensive set of test transactions that include both valid and erroneous data values that fall within and outside the test of parameters. An analysis of the test results will show the auditor which type of errors can pass undetected by the validation program. This evidence will help the auditor determine the nature, timing, extent of subsequent substantive tests. Next is batch controls. Batch controls are used to manage high volumes of transaction data through a system. The objective of batch control is to reconcile output produced by the system with the input originality entered into the system. Batch control is initiated at the data input, staged, and continues through all phases of data processing. For example, a batch supplier invoices enters the system at the enter stage after each subsequent processing stage. The batch is reviewed for completeness. The information contained in the transmittal sheet is entered as a separate control record that the system uses to verify the integrity of the batch. Periodic reconciliation between the data in the transmittal record and actual processing results provides assurance of all the invoices that were entered into the system were processed, no invoices were processed and paid more than once, and all invoices entered into the system are accounted for as either successfully processed or rejected because of errors. The failure of batch controls to function properly can result in records being lost or processed multiple times. For example, assume that the transmittal record of a batch supplier invoices shows that 100 records with an invoice total of $285,458 entered the system. The completed batch log, however, shows that 100 records were processed with a batch total of $288,312. What caused this anomaly? Did the system process one record twice due to a programming error? Or was an extra record entered into the system during processing? Or did the data entry clerk incorrectly calculate the batch control totals? By reviewing and reconciling transactions listing and error logs, the auditor should be able to obtain answers to these questions.
Purchase authorization controls. Where do purchase authorization occurs? Purchase authorization actually occurs in the revenue cycle when goods are sold to customers. At that time, the system compares the quantity on hand with the reorder point to determine if the inventory needs to be reordered. If so, a purchaser's requisition for the standard order quantity is created and the item is flagged on order to prevent subsequent orders from being placed. In the expenditure cycle, the purchase requisition file is sorted by vendor number and purchases orders are then prepared. So, how should we test the purchase authorization controls? First, the auditor needs to verify that the correct order quantity is used when a requisition is created. Errors in programming logic or data entry may result in unanticipated stockouts, excessive ordering cost, or overinvestment in inventory. Second, the auditor should verify that the inventory record is flagged on order when a requisition is first prepared. Failure to do so will result in overinvestment in inventory due to multiple orders being placed for the same item. Employee authorization. Personal action forms were prepared and submitted by the Personnel Department to the Payroll Department. So, where do these documents used for? First, these are used to effect changes in hourly pay rates, payroll deductions, and job classification. Second, these also identify employees who are authorized to receive a paycheck. And lastly, the information plays an important role in preventing errors in payroll fraud. What kinds of payroll fraud can possibly occur? A common form of fraud is to submit time cards on behalf of employees who are not employed by the firm. Another common fraud is to create checks for ghost employees. So, how should the organization prevent these kinds of fraud? Someone in the payroll department should be designated to compare time cards with the list of authorized employees sent from personnel. Failure to implement employee authorization procedures can result in payroll distributions to unauthorized individuals. Then, how should we test the employee authorization procedures? Auditor needs to determine that effective procedures exist in the personnel department to identify current employees, communicate their status completely, and correctly to the payroll function and monitor adherence to employee authorization procedures. The auditor can assess the correctness of program procedures that validate employee authenticity by using either the test data or integrated test facility or the ITF approaches. This testing involves creating a dummy authorized employee file and a corresponding attendance file containing both records that match and some that do not. A correctly functioning payroll application cannot successfully validate payroll transactions if the authorized employee file is itself invalid. Therefore, the auditor can obtain assurance that the file has integrity when the following controls exist. First, access to the authorized employee file is password controlled. Second, additions to and deletions from the file are restricted to authorized individuals in the personnel department. And lastly, the employee records stored on the file are encrypted.
Now let's move on to process control. What is process control? This includes computerized procedure for updating files and restricting access to data. This may also include physical controls associated with manual activities. There are 3 control techniques related to file updating. First is a sequence check control. In systems that use sequential master file, mostly legacy system, the order of transaction records in the batch is critical to correct and complete processing. As the batch moves through the process, it must be resorted in the order of the master file using each run. An out-of-sequence supplier's invoice record in a batch will prevent other downstream records from being processed, or worse, it may be processed against the wrong supplier's account. A sequence check control needs to be in place to compare the sequence of each record in the batch with the previous record to ensure that proper sorting took place. Second is the liability validation control. This control involves reconciling supporting documents including the purchase order, receiving report, and supplier's invoice. In business environment where discrepancies in price, charge, and quantities received are commonplace, the validation process is difficult to automate. In this type of business setting, many organizations employ manual procedure for reconciling supporting documents and validating the liability. Trading partner relationships stabilize the business environment and permit organization to depart from traditional accounting procedure. Because prices, quantities, and product qualities are guaranteed by the trading partner agreement, the liability validation process can be greatly simplified and automated. Lastly, testing file update controls. Failure of file update controls to function properly can result in transactions not being processed, means liabilities are not recognized and recorded, being processed incorrectly, payments are approved for unauthorized recipients, or being posted to wrong supplier's account. Test of file update controls provide the auditor with evidence relating to the management assertion of existence, completeness, written obligation, and accuracy. Tests of sequence check can be performed using either ITF or test data approach. The auditor should create test data that contains records that are out of sequence in the batch and verify that each was handled correctly. The auditor needs to verify the mathematical correctness of the procedure. Testing the liability validation logic requires understanding the decision for matching supporting documents. By creating test purchase order, receiving reports, and supplier's invoice, the auditor can verify whether the decision rules are being correctly applied. Similarly, the ITF and test data method can be used to test the effectiveness of valid vendor control. Valid vendor file consists of a list of vendors with whom the organization normally does business. Fraudulent transaction in the expenditure cycle often culminate in a payment to someone posing a legitimate vendor. This testing involves creating a reference file of valid vendors and a file of supplier invoice or accounts payable to be paid. The efficient use of logic testing CAATTS such as ITF requires determining in advance the input and process controls to be tested. A single audit procedure can be devised that performs many or all of the needed tests.
Access controls. It prevents and detects unauthorized and illegal access to the firm's assets. Inventories and cash are the physical assets of the expenditure cycle. These are the traditional techniques used to limit access to these assets. First, warehouse security such as fences, alarms, and guards. Second, moving assets promptly from the receiving dock to the warehouse. Third, paying employees by check rather than cash.
Controlling access to accounting records is important. Individuals with unrestricted access to the data can manipulate the physical assets of the firm and cause the financial statements to be materially misstated. These are the examples of risks specific to the expenditure cycle. First, an individual with access to the accounts payable, subsidiary ledger, and supporting documents could add his or her account or someone else to the file. Once recognized by the system as a legitimate liability, the account will be paid even though no purchase transaction transpired. Second, access to employee attendance cards may enable an authorized individual to trigger an unauthorized paycheck. Third, access to both cash and accounts payable records could remove cash from the firm and record it as a legitimate disbursement. Fourth, access to physical inventory and inventory records can steal products and adjust the records to cover the theft. Testing access controls. Access controls lies at the heart of accounting information integrity. In the absence of adequate controls, supplier invoices can be deleted, added, or falsified. Payroll account balances can be erased or the entire accounts payable file can be destroyed. Evidence gathered about the effectiveness of access controls tests the management assertions of existence, completeness, accuracy, valuation and allocation, rights and obligation, and presentation and disclosure. Since payments to false vendors has potential for material loss, the auditor is concerned about the integrity of the valid vendor file. By gaining access to the file, a computer criminal can place his or her name on it and masquerade it as an authorized vendor. Therefore, the auditor should assess the adequate controls that protects the file. This includes the password controls, restricting access to authorized managers, and using data encryption to prevent the file from being read or being changed. Computer access controls are both system-wide and application-specific. Access controls include the controlling access to the operating systems, the network, and the databases, which all applications interact. The auditors will typically test these controls as part of their review of the general controls. Physical controls include manual activities and human actions to initiate computer procedures to safeguard the assets of the organization. These are the examples of physical controls for purchases and payroll systems.
Next, we have purchases system control. And under the system control, we have first, segregation of inventory control from the warehouse. And the primary asset at risk in the expenditure cycle are inventory and cash. Warehouse clerks responsible for asset custody should not be given responsibility for maintaining inventory records. Otherwise, inventory could be removed from the warehouse and the accounting record adjusted to conceal the event. Second, segregation of the general ledger and accounts payable from cash disbursement. An individual with the combined responsibilities of writing checks, posting to the cash account, and maintaining accounts payable could perpetrate fraud against the firm. Third, we have supervision of receiving department. Large quantities of valuable assets flow through the receiving department on their way to the warehouse. Close supervision here reduces the chances of two types of exposure. The first one is the inspection of assets. When goods arrive from the supplier, receiving clerks must inspect the items for proper quantities and conditions. Second one is the theft of assets. Receiving departments are sometimes hectic and cluttered during the busy periods. In this environment, incoming inventories are exposed to theft until they are secretly placed in the warehouse. Improper inspection procedures coupled with inadequate supervision can create a situation that is conducive to the theft of inventories in transit. Going further, we have the reconciliation of supporting documents. The Accounts Payable Department plays a vital role in controlling the disbursement of cash to vendors. Copies of supporting documents flow into this department for review and comparison. Each document contains unique facts about the purchase transaction, which the accounts payable clerks need to verify before the obligation is recognized. What do we mean by supporting documents? Supporting documents, we have first, the purchase order, which shows that the purchasing agent ordered only the needed inventories from the valid vendor. The second one is the receiving report,
which is the evidence of the physical receipt of the goods, their condition, and the quantities received. The reconciliation of this document with the purchase order signifies the point of realization of the obligation. The third one is the supplier's invoice, which provides the financial information needed to record this obligation as an accounts payable. The accounts payable clerk verifies that the prices on the invoice are reasonable. Moreover, we have payroll system control. Under this control, we have first, verification of time cards. The time card is the formal record of daily attendance. Each day at the beginning of the shift, employees place their time cards in a special clock that records arrival. They clock out for their lunch period at the end of the shift before sending time cards to payroll. The supervisor must verify their accuracy and sign them. Second is the supervision. Sometimes an employee will clock in for another worker who is late or absent. Supervisors should observe the clocking process and reconcile the time cards with actual attendance. The third one is the paymaster. The use of an independent paymaster to distribute checks rather than normal supervisor helps verify the existence of the employees. This control is useful in uncovering a fraud whereby the supervisor is pretending to distribute paychecks to non-existent employees. And for the last one, we have the payroll impress account. Employee paychecks are drawn on a special payroll impress account at the bank, which is used only for payroll clearing. Funds must be transferred from the general cash account to the impress account before the paychecks can be cashed. The amount of the funds transfer is determined with the payroll register, which is reviewed for correctness and approved by accounts payable. The impress account technique physically limits the organization exposure, and individual checks that exceed the impress amount will not clear. This result will expose the existence of checks written in error or duplicates or created through fraudulent activities.
Testing physical controls. Inadequate segregation of duties and lack of supervision can result in fraud and errors that can cause financial statements to be materially misstated. Granting inappropriate access privileges is often due to assigning incompatible duties to an individual. Similarly, the purpose of collusion is to achieve unauthorized access to assets as well as the information needed to conceal the crime. The auditor's review of organizational structure should disclose the examples of incompatible tasks, such as one individual opening and approving time cards, authorizing employee payments, and receiving and distributing paychecks. Covert relationships that may lead to collusion may not be apparent from an organizational chart. For example, married employees who work in incompatible areas may go unnoticed, so the auditor should determine whether the organization has an effective policy for dealing with nepotism. Many tasks that are normally segregated in manual systems are consolidated in the data processing function of computer-based systems. Computer programs in the expenditure cycle authorize purchases, place orders, update inventory records, approve payments to vendors, and write the checks. In automated environments, the auditor's focus is on the integrity of the computer programs that perform these tasks. These questions needed to be answered. Is the logic of computer program correct? Has anyone tampered the application since it was last tested? Have the changes made to the program caused an undisclosed error? Are there adequate formal procedures to compensate for the lack of segregation of duties? Answers to these questions come from the auditor's review of system development and maintenance controls and by reviewing organizational structure.
Next is output controls. Output controls are designed to ensure that the information is not lost, misdirected, or corrupted, and that the system processes functions as intended. For example, daily summaries of cash disbursements to vendors and inventory receipts should go to manager to report the status of their operations. Output controls is designed to identify operational and internal control problems. Reconciling the general ledger can detect certain types of transaction processing errors. For example, the total of all reductions to accounts payable should equal to the total cash disbursements to the vendors. meaning if we pay our liabilities, then our cash disbursements will be equally affected. A cash disbursement that is entered in the journal but not posted in the vendor's account would be detected by an imbalance in the general ledger. Entities often group transactions into small batches of 50 to 100 items instead of summarizing an entire day's transactions in a single batch. By isolating a problem to a specific batch, finding errors and reconciliations of transactions became easier. Another important element of output control is the maintenance of an audit trail. The following are examples of the audit trail's output control. First, Accounts Payable Change Report. This document is a summary report that shows the overall change in the accounts payable. This should reconcile with the total vendor invoices received, total cash disbursements, and the general ledger. Second, Transaction Logs. Systems successfully processed transaction should be recorded on a transaction log, which serves as a journal. Transactions rejected because of input errors should be placed in an error file, corrected, and resubmitted. Next is the transaction listing. The system should produce a hard copy transaction listings of all successful transactions. Listings should go to the appropriate users to facilitate reconciliations with input. For example, a listing of cash disbursements processed will go to the controller to be used for the bank reconciliation. Fourth is the log of automatic transactions. Some of the company's transactions are triggered internally by the system, and all these internally generated transactions must be placed in a transaction log to maintain an audit trail. Listing of these transactions should be sent to the appropriate manager for review. Fifth is the unique transaction identifiers. Transactions processed by the system must be uniquely identified with the transaction number. This helps with the tracing of a particular transactions through a database of a large number of records. And lastly, the error listing. This is a listing of all error records which should be sent to the appropriate users to support error correction and resubmission.
Testing output controls. The absence of adequate output controls has adverse implications for operational efficiency and financial reporting. Evidence gathered through test of output controls relates to the completeness and accuracy assertions. Testing output controls involves reviewing summary reports for accuracy, completeness, timeliness, and relevance to the decision that they are intended to support. In modern systems, audit trails are usually stored online as text files that can be read by word processing and spreadsheet programs.